Hello, and welcome back to the conversation. My name is Michael Barnett, your host, and today I am joined by Thorsten Seeger. Thorsten is a 20 plus year veteran in the SMB lending space. He spent the entirety of his career in the European market, and currently today, Thorsten acts as an expert advisor to fintech players all over Europe. Super happy to have Thorsten in the podcast today. We're going to talk about some really amazing stuff. We're going to spend a lot of time focusing on the embedded lending industry, what's happening in the industry today. We'll talk a little bit about the future of the industry, inclusive of things like ethical practices. And we'll even compare and contrast some of the differences and similarities to the European market to the US market. Thorsten, glad to have you on today.
Thanks, Michael. Glad to be on there.
Awesome. So I guess you and I met through my co-founder, Sasha, and the two of you connected. Can you talk a little bit about how the connection happened and how we ended up here today?
Yeah, it's actually quite a funny story in a way that we've been connected on LinkedIn for some time. And then a little bit later, I actually realized that one of your guys in your team was doing the MBA together with me in Shanghai in 2005. So I knew him from them, just showing
Wow.
how it's such a small world it was. But yeah, Sasha and I have been talking on and off over the last few years, actually, about the differences in the markets in the US and the UK, and just kind of chit-chatting about where the industry was going.
Fantastic. Well, the power of LinkedIn, right?
It is
I mean,
amazing,
that's
isn't it?
tool's amazing. And I've made many, many new and great connections through LinkedIn, and glad that you're here. And I'm glad that you and Sasha were able to connect because I'm ready to pick your brain because as I mentioned in the intro, you are the expert in the European market. That's an area where Loanspark, we haven't ventured into the European market as of yet. We kind of dabbled in it a couple of years ago, just for just a moment, and realized that we weren't ready for that just yet. So instead, we decided to try our products in Canada, which has been successful for us so far. So I think at some point in the future, we will take our embedded lending technology and our platform into the European market, but not ready for that yet. So really here to pick your brain to understand what's happening in Europe on the embedded lending side. And I guess, where things are today and where you think the future of embedded lending will go in Europe.
And I'd be definitely very happy to welcome you in Europe once you feel that you're actually ready. And it's always scary, of course, in a sense, to be called an expert, right? Because that puts the bar very high. So I would say I've spent a few years in this market and I've seen a number of bits and pieces, but experts are always very difficult to find. But yeah, no, I spent some time at Funding Circle. I spent some time in October, and those were two of the leading platforms that we have in Europe and within the EU. So I've seen a little bit, but I'd still be very careful with the expert tag.
Come on, Thorsten. I mean, think about it. You and I both have been in our industries for at least 20 years, right?
Yes, indeed.
You've been in your industry for 20 years. I've been in commercial lending for 20 years. And I consider myself an expert.
Excellent.
I think there's experts at varying levels, but I think when you're doing something for a significant amount of time, and if you're doing it well, I think you could probably others will consider you an expert,
Probably
right?
true. Probably true. And
Right.
it's funny, isn't it? In a sense, if you think about both of us being in this industry for 20 plus years, and to think about how little has actually changed in the industry, and at the same time how much has changed. I mean, I don't know about the US, but if you think about the European markets here, to a large extent, this industry still is pretty much exactly the same as it was 20 years ago. And then only on the fringes, we see new players emerge, new technologies emerge, and those actually having a huge impact. But the overall volume of those within the overall context is still marginal, right? I mean, within the European markets, apart from the UK, I would say, but in the continental European markets, new technologies are not making a big wave in the lending industry yet. How is that in the US actually?
In the US, I would say over the last 20 years, I think the volume of lending has increased. Like the units in volume have increased. From a technology perspective, I would say that the technology today versus the technology in 20 years ago, I mean, it's not like knock your socks off, right? That there's that much of a difference. But where there is a difference is I think that the technology is now more accessible. It's more accessible to more people because the way that like the development technologies to build fintech integrations, it's now easier today than it ever has been. So if you are, let's say, a college student who is studying finance or development, and you want to develop your app, the tools are there for you to click a few buttons and you can develop an app in a weekend, right? So I think that's where things are different now, where it's so much easier to build fintech platforms or integrations than it ever has been. You just see more of it
Yeah,
because 20 years ago, embedded lending existed. It just wasn't ubiquitous like it is today. Today, it's everywhere on the consumer lending. I would say embedded lending, the way that we know it, is probably more common and has been more common. Commercial embedded lending, again, it's not new, but it's something now that's becoming more common because governments, politicians, large businesses, investors, bankers see the more need now to invest in small business and business lending than I think ever before. And in my opinion, business lending has always really been a missed revenue opportunity
for
for
sure.
investors that now is really being taken advantage of. So we hear about it more. So that's my opinion.
Yeah, I think you're right with that. I mean, I heard a guy say a few days ago, and actually, I think it was a good explanation when he was talking about the rate of technological change and what to expect in the future. And he was kind of saying we're in the second half of the chessboard now. And I think on the overall technology side, that's probably true. I think when we think about the impact of technology in the lending industry, specifically on the SMB side, I think we're very early in the early half of the chessboard still as of today, but probably can pick up quite quickly.
You're right.
What we've seen here in across the continental European markets and specifically is that COVID was really a huge accelerator for the acceptance of technology. And I think as for a lot of players, the early days in 2020 were probably very hard and challenging, like for everybody else in the world as well. I think from an industry perspective, it really helped us because the acceptance of people to do things in a digital way has just so much increased. I mean, particularly in Germany in 2019, it was still so hard to get people to do anything in a digital way. When I'm saying people, I mean small business owners, right? They were very stuck in their ways, and not all of them, but the majority. And then you just fast forward 2 years, and all of a sudden, people are much more open to use their phone to do stuff, to talk on video, to actually do a deal with somebody that they've never met in person. That was unheard of 2019, and
Unheard
starting in
of.
2021, so much easier. So
It's
a
like
real
a,
accelerant for us.
it's like it's, that's a great point that you made because I think you're nail on the head there. COVID created forced acceptance. And I mean, my over 90-year-old grandfather uses technology. He's on an iPad, which is pretty
Exactly.
cool, right?
And it's
Right.
pretty awesome, right? Yeah,
It's pretty cool, right? But so technology has become easier, but through COVID was definitely this forced acceptance period, which it's like there's a gift and a curse to events like COVID. The gift is for those like us, the experts in fintech, it's great because now it's much easier in order for the consumer or the end user to accept your product. The downside is all the downsides that we know that came along with
for
COVID.
sure.
But so in the mid 2000s, I think it was 2011 or 2012. I worked for this at one point small company, On Deck Capital. I think there was only maybe like 50 or 60 of us at the company at that time. And we were building what we thought was a super innovative commercial lending technology where a client can essentially go online and do everything online from beginning to end.
Mm-hmm.
And then they would get like, in addition to their loan, they would also be able to get like what was called like performance indicators about their business. And like they would get this free service where they would connect their bank account. Now connecting your bank account is like, it's old school
Standard.
technology, right? But you would connect your bank account and you would get information about your cash flows, your revenues, your trends. Between 2010 and 2000 and let's say 16 or 15, we had that product. The acceptance was so low
Yeah.
because no one was comfortable connecting anything, any
Mm-hmm.
accounts. And then,
Yeah.
of course, like mint.com also was launched, I think, right around that time. Mint was a big product here in the US. I'm not sure if it was a big product in Europe, but in the US, it became a big product in the US. And it was like the first product where you could connect your consumer accounts all in one platform and then get insights about your spending behaviors, credit cards, bank account, etc. And it would do all the analysis and acceptance. So we had a tough time getting acceptance for those products. But then COVID comes and it's like, bam, everyone's online, right?
Much more
Absolutely.
comfortable. Yeah.
Much more
Having said that,
comfortable.
I think with connecting bank accounts, it depends a lot on the industry and on the country to a certain extent as well. But what I see in the European market is that there's still a fairly big hurdle for the SMBs to say, okay, I'm gonna let you get access to all my accounts. I'm really open. So there's certain industries like in the e-commerce space where I've seen a lot more of that, and where lending players are just putting a proposition together where you just have to, and if you don't want to, then sorry, you cannot get a loan. But within the majority of what I would call normal small business lending, there's still a huge reluctance, and actually most businesses still done on PDF bank statements. And I think this will be a huge unlock that we will see over the next 4 to 5 years across continental Europe as well, where people just need to get so much easier on that and so much better because, I mean, what better data to look at than bank statements?
Exactly. Do the banks, when you continuing on the topic of technology and technology offerings that an end user then has to accept, how tech how technologically forward are the banks in Europe? So are they offering, do they have APIs, or are they offering these kind of more sophisticated technology, or are banks more, kind of still on their antiquated, I call it old school, right, systems that they've been operating on for, since the dawn of, time?
It's a ton of time, yes, very much. I think obviously this depends a lot on the bank and the country, but I would say the vast majority of traditional banking players are still very much doing exactly like you said. They're behaving like dinosaurs really in this space because there's not that much need for them to move away from it. It really depends a lot because Europe is a quite diversified market when it actually comes to banking and especially small business banking. So there's not like a small number of predominant players that are really huge across all of the different markets. But what we see in lending really specifically is that, and banking as well, that we're talking about a multi local market is what I would probably say. So nobody is really active in more than 3 or 4 markets, and that's true both on the fintech side and on the banking side. So we haven't got like a European bank where you'd say they're available all across. And then if you kind of narrow it down to just Germany, which is the market that I know probably the best out of all of the European ones, we've got so many local. I think in the US you call them community banks or savings banks, right? Like very very local, very small, but they have a huge market share in the small business segment specifically because a large bank cannot be bothered to really look after the small business customers very very well. And then you have got a few players that are kind of building propositions that are much more digital, that are much more cool in a sense, much more technology driven, but they're far in between. So the majority of the market really very local, very, very old technology and not quite open yet, and then a few outliers that are really trying to make a change.
I wonder how much of that drives the consumer's behavior. So when the organizations that a consumer or an end user typically does business with or interacts with doesn't require the use of technology, and then here comes Michael Barnett, right? Or here comes, Thorsten Seeger with his technology, and we're fighting for acceptance. In some cases, I think that may have something to do with the fact that these organizations, like even the small banks or even some of the bigger banks, have not yet adopted the latest technologies and are forcing their clients to use those technologies. So that's like, you're not getting used to it. It's not something that's normal yet for the end user.
I completely agree with you, Michael. And I think I would actually go one step further than that and say sometimes they're actively discouraging their customers to kind of try something new and stoke fear of the unknown and the technology and say, oh, better stick with us because you know us very well and don't get scammed by somebody from the internet, right?
Exactly.
And so they really create that fear.
That's happened a few times with us at Loanspark, where we use technology to connect to bank statements or bank accounts and read the bank data so we can make decisions, near instant decisions in some cases. And there's been circumstances where let's say the connection didn't work, or just we needed some gatekeeper on the banking side to authorize or do something. And so the client would reach out to their bank, explain the situation, only for the bank to tell their customer to not do it. Like,
Yes,
don't do it. Don't connect. It's a scam. And not a scam, right?
obviously not.
We use the latest and greatest technology built on, supported by MasterCard, et cetera. It's all like, it's the best stuff. But just because they just don't know. And that isn't helping the future
No,
of embedded
for sure
lending,
not. For
Thurston.
sure not. But I think the good news is that you only need a few more innovative players, and I think they are definitely there. And when you have got a few people who say, actually, let's start using this technology, and they do that also in the traditional banking world, and they kind of use technology like the ones that you've built, and they connect through. And I think the embedded side of things is really where I'm seeing a lot of the growth coming from in our specific SMB lending industry. I think it's very different on the consumer side. It's much more established there already. But on the SMB side, I really believe that as of today, we're still waiting for the development of the really great use cases on embedded lending. And once we see a view and we've got a few more innovative players, then the other ones will be forced to kind of pull along. And I think that will be a very good moment for us in this industry.
Correct. I also, to piggyback on that, I think that the more, not that we want to create, I mean, Loanspark doesn't want to create more competition, but the more players that enter the market and the more ubiquitous this technology becomes, and the more companies that businesses like Loanspark partner with to offer embedded lending, the more common it becomes. That's why I think that's one of the reasons why I believe that embedded lending platforms like Loanspark are really important. They're I say it's important today, but I think 10 years from now, when we're kind of conducting a post-mortem on how important it was, I think that's when we're going to see how important the embedded lending platforms of today were and how it impacted the future of lending. And what that looks like 10 years from now, I don't know. But what I do know is that, the industry, small business lending, still has a lot of work to do from a technology perspective,
Yes.
technology perspective, full stop. And embedded lending providers can significantly influence that market and its growth of,
Oh, for sure.
So
For sure.
really glad to be a part
Because
of it and looking
I
forward
mean,
to it.
if we were waiting for the large banks to kind of drive this market by themselves, I think we could still be sitting here in 20 years, and then we'll probably really call ourselves the experts. but we'll be sitting here in 20 years and not much has changed. Having worked for large banks for a long time, obviously nobody should ever say everything is bad at large banks. It's not, right? They have a lot of constraints and a lot of things that they're working on, but they're just not the organizations that will drive innovation and change in the industry. They're the stewards of their customers, and they will pick up things that are actually working well. But it has to be organizations like Loanspark that actually driving the change, driving the innovation, and become the best in class player that then can drive the technology inside those banks and outside those banks. So I think it's a good development for all of us. But it's important that we all exist, and that this alternative lending industry is there. And I mean, I see it in some markets where alternative lending, the UK is a great example, where alternative lending is no longer really alternative in my mind, but actually drives the majority of small business lending, or at least new loans, and the banks are more kind of keeping their existing book and recycling that. But any additional stuff is done by what we would have called alternative lenders in the past, and I think today they're already mainstream. Well, not quite mainstream, but at least accepted in the society. And I'm really waiting now for the rest of Europe to catch up with the UK here. And I think the US is also pretty well advanced already.
We are pretty advanced in terms of the alt lending versus non-alt lending, but what I would say is alternative lending has become more mainstream here since COVID, more mainstream over the last 4 years, but we're not quite there yet to where I could say that alternative lending is it's a mainstream product that a business expects. They expect under certain circumstances. Still here, I would say that, and again, I'm speaking anecdotally.
Yeah.
But I believe that the vast majority of business owners, or those who are seeking a loan, think that still they should go to their bank first for the bank loan. And in the event that they can't get a bank loan, then everything else is not as good as a bank loan. And I think that is due to misinformation, and partly misinformation. But also the other part of it is banks have been the dominant force since the dawn of time, right? When it comes to lending.
Of course.
Right? Business lending. So I think here it'll be probably 5-10 years more before alternative lending really becomes the accepted norm when a business owner is looking for maybe less than 5 to 10 years, but I don't think any less than 5 years, to where it becomes the accepted norm.
Yeah.
We're getting
it's a good point. It's a good point. And I think specifically the embedded component here will make a huge change in that, because taking out the process break that the business owner had in the past, where they kind of said, okay, now I know that I need some money and I need to switch to a new screen, switch to something new, and pick up the telephone to my bank in order to get that loan. As long as we have that process break, I think it will always, not always, but for the foreseeable future, bank that gets that first call to provide the money. And when we can provide an embedded product on an instant basis that is just flowing through the user journey of the purchase or the investment or whatever they want to do, I think that will help us tremendously, because all of a sudden the consideration is no longer, who am I going to call to get this loan, the bank, to going to actually, I need money. It's available here. I just need to click my button and have access to it. So take away the choice. It's not like customers want choice. We all know that, right? Customers don't like to have more choice, but they want to know that they've done the right choice. And by facilitating that through a seamless process, I think we will be able to actually make very fast inroads pretty quickly, actually.
Okay. I'm with you on that 100%. Let's transition a little bit and let's talk about ethical business practices. This is a topic that here at Loanspark, we pride ourselves in. And one of the 3 or 4 things that we discuss heavily when we're marketing the Loanspark platform to others, whether it's a bank or whether it's a non-bank organization that's looking to partner with us, the ethical nature of what we have committed to here at Loanspark and how we conduct business has been something that has been really important to us and is one of the reasons why I founded Loanspark to begin with. So I guess ethics is an opinion, right? But then there are things that are, I guess there are just ethics that can be backed up by law,
Yeah,
right? It's
yeah,
unethical to do this. And if you do this unethical thing, then you are in violation of the law, right? And one of the things that you could clarify for me, and I'm sure for others who are watching our podcast today, is what are some of the acceptable and unacceptable practices in Europe? Because in the US, it's very murky, yeah, in terms of ethics. It's very murky. There are acceptable business practices, and then there's unacceptable business practices, and then there's the law. And the
yeah.
law is not very defined in the US as it relates to commercial business lending. It's very unclear.
Yeah, so I think in Europe, this again, and I think this has to do a lot with the legal system that actually different countries have. So the UK would be very similar to the US in a sense where you have got a case law structure and things are not as clearly defined and then maybe more defined by the courts in case there is a dispute. Versus in countries like Germany or France, it's a much more statutory driven legal framework where they try to regulate everything from the beginning, and the court has just to try to decide whether this paragraph applies or not. And I'm not saying that either side is better or worse, but they're just incredibly different in the way that things are done. Now, what I would probably say is when it comes to the ethics of lending, I mean, the first port of call I think that people always go to is kind of what are the rates that are still considered to be ethical, and at what moment in time
Prices.
do you move in a price that is predatory. And I think on the consumer side, this is of course in every country incredibly well regulated, versus on the SMB side, much less. So for example, in Germany, there's no maximum rate that you theoretically could charge to a small business, whereas in France and in Italy, for example, there is very clearly defined maximum rates, and you cannot go above those. Now they change over time, so I'm not exactly sure where they are, but I would say as of today, the interest rates that I would consider maximum in Italy and France would probably be sitting somewhere between 20 and 30%. But in reality, if you actually have an APR that is like with a two in the beginning on a normal loan, I think most people would already consider this as incredibly high pricing and
Wow.
potentially
Okay.
even unethical.
Understood.
Lawful, but potentially difficult. Now, this changes a lot in when it comes to the NPL providers. That changes a lot when it comes to very short-term financing providers, where of course, like for a 30-day loan, the APR might be a lot higher, but then it becomes a little bit more murky. And I think we have seen some examples in the European markets where people were starting to play around with that, and I felt that I didn't feel comfortable with that. So people started to move from yearly interest rates and APRs, and then we started showing monthly interest rates. And I've actually seen one example where a company was showing daily costs. And I did not feel comfortable with that because it was showing daily costs of 0 point something, whatever percent. But I didn't feel that a small business owner would actually understand what that means in reality and how to compare that against another offer. But it's not unlawful, so these kind of practices exist. What's
Okay.
probably also quite interesting is an anecdote I've just really recently heard from Italy, because we had seen a small business lending through alternative players really was getting very strong in Italy in the years since 2020, pretty much on the back of state guarantees. So when we started to see the pandemic, all of the countries in Europe really increased the availability of state guarantees to small businesses in terms of the lending. But the Italian one was probably one of the largest programs we have seen, and one of the widest programs where a lot of people had access to that, both on the lender but also on the borrower side. And it transpires that some players have probably taken advantage of that a little bit in a way of building a lending framework that was really dependent on the government guarantees at 90% or 80%, as opposed to really considering whether or not a company could indeed repay their loan out of the business practice. And that got quite big, but now in the last 6 to 12 months, the Italian regulator actually has really started to become much more aware of those practices and very unhappy about those practices, and has started to shut them down one after the other. And it was really interesting to see because, of course, as you said, nothing that has been done was unlawful, and everything happened within the letter of the law, but maybe not the spirit of the law. So we have seen quite a lot of action taken by regulators to make sure that these state guarantees were not abused. And I think that's the right call.
Right. Yeah. And I agree. And, I agree that there should be and needs to be a degree of regulation in the commercial lending industry. Now, I am not going to be the big proponent of over-regulation, because I think over-regulation can cause problems and can constrain opportunity and can crush innovation. But I do believe that there should be some degree of regulation when it comes to business lending. And, the tough part about how that works here in the US is we have 50 states. And because we have 50 states, there could be different regulations in each state. Actually, there are certain states who have passed some semblance of regulation as it relating to disclosure law. Mm-hmm. So when quoting, there's certain information that needs to be provided in the quote. When you're finalizing a transaction, there needs to be a document that clearly describes the financial component to the end user. And so there's only a handful of states that have adopted anything like that here in the US.
Okay.
And there isn't a national guideline on what's predatory or not predatory, because we still do see, I've seen, and we do see out there and hear stories about the 100 APR loan, mostly short-term loans, very short-term loans. So we've seen it. We've heard about that. And how common it is, I don't know, but we've heard of it, and it's not illegal here in the US. So just like you were saying a moment ago, whether something is illegal or not, it's the organization that's providing the funding. They should have some degree of ethics and how they are helping the borrower accomplish their goals. And so I think that ties into the organization that's offering the lending and what they subscribe to from, in their mission, and how that ties into their ethics.
Yeah. So, and this is actually a really good point, Michael, that you make here, because whilst, of course, a lot of the lending players are not regulated, actually, a lot of the financing providers at the back they're often asset managers, they're pension funds, and they are quite heavily regulated. And also, at least in Europe, they often really care quite heavily about their reputation. So if you were a lending platform and let's say you went out with 50, 60, 70% APR on your loan, and it was not illegal, I think your funders would very quickly actually put a stop to that and say, look, we don't want to be associated with these kind of business practices because it's bad for our name. And I think the US are much more open to this. Not necessarily like 100 APR as you mentioned, but I think at least that is my kind of outside in view, that the US is much more business friendly and open to business. And you say, look, everybody has got the right to make their own decisions. And if you want to take that loan, you're not forced to do it, but we want to give you the opportunity. Versus Europe is a lot more protectionist in a sense. They say, no, we need to protect people from themselves and protect people from making bad decisions, which can sometimes be really helpful, but sometimes can stifle innovation and can stifle people to actually come out of their shell and keeps them small. So some ups and downs, of course.
I think that's also where product education is really important. And it's one of the things that we do at Loanspark. Although we are an embedded lending platform, we do include a degree of product education when
Really?
our
Wow.
customers are accepting loans. We educate them on the loan, how it works, how the interest works, how their payment collection works, the time frame, and we work with them to ensure there is a reasonable business case for the type of loan that they are accepting, because
Okay.
sometimes a business owner may apply for a specific loan and not get what they applied for. But then there's the alternative, as we discussed a little while ago, the alternative lending.
Okay.
And that's where I believe the education more or less needs to happen, is on the what you and I would call alternative lending. Just because they work different. Alternative loans can work different than a typical bank loan. But
Yeah,
I
it's a
think
good
one
point.
thing that consumers don't necessarily look at and pay attention to is that, at least in the US, the most common finance vehicle in the US is a mortgage.
Of course.
Mortgages typically come in terms of 15 years or 30 years. The most common mortgage vehicle in the US is the 30-year mortgage. May not be the best vehicle, but it is the most common vehicle, because my dad had a 30-year mortgage. My grandfather had a 30-year mortgage. By golly, I'm going to have a 30-year mortgage as well. Okay. With a 30-year mortgage, let's say you're paying 5% and it's a $500,000 mortgage over the course of time. So over the course of 10 years, 15 years, 20 years, when you look at the cost of your capital, no one reads that fine print. When you look at the cost of a $500,000 mortgage at 5%, you're paying a few $1,000,000 in interest, right, over the course of your loan, which is baffling when you just look at the way that, the interest is amortized. So even mortgages can be really expensive when you look at the way that the interest rate is compounded over time. And that's not something that I think consumers look at, or business owners look at so carefully, because they're seeing, you look at, what is my payment today? My payment is $500. Okay, I can handle that.
Yeah.
But over the course of that long term, you're paying a lot. It's not avoidable. You can't avoid it. But it is a necessary reality that you are going to pay a lot of interest over a long period of
Yeah, it
time,
makes a lot of sense.
right? Or there's other things, Thorsten. Have you used an ATM machine before? You take your debit card, you put it into the machine, you type in your PIN, and the machine says the fee to take $20 from the machine is $3. What is the interest cost that you just paid on to deduct the $20 from your account? Essentially, you just paid 15% interest, right, to deduct the $3. And then some banks charge the customer on the back end to take money from the ATM. So maybe you pay 20%. It seems we don't little things that we don't think about, but when we're comparing it to what we
And
do on the commercial lending side, there's other types of financing that we as consumers have become so used to that can be infinitely more expensive.
so true. And I think a lot of that has to do with the fact that people are inherently very bad at maths, and figuring out how percentages work is incredibly hard for people. So they think it's only $3, so it's okay. If they understood that, actually, I mean, really understanding percentages, a lot of people struggle with, and understanding compound interest, to come to your point from before, that's something that people really, really struggle with. Right? I think we should actually, that's something for like a call to the state to get better at teaching children in school more financial skills and understanding actually how these kind of things could work. That would go a long way. That's something I see common all across Europe, and probably the US as well. Is like financial education of people could be so much better. So I'm really thrilled to hear actually that you guys are educating your customers about product features and parts of the product to make sure that they actually understand what they're signing up for. And I'm sure that sometimes that costs you business, but I do very much believe it's the right way of doing this. And in the long term, it can only be positive for the business and the industry in general.
It does. It does. The cost is speed. In some cases, transactions move more slowly than others because of the educational component. But we believe that helping a business owner make the best decision that they can with the information that's readily available today is the right thing to do. And tying back to the ethics side of the discussion, we would never want to be that company that is on the negative side of an ethics debate. And there's enough of that happening. I'm sure you and I both can pull articles from the news to say this provider, that provider, this player, or that player was under the microscope because of what they've done, what they've offered, or how they've structured a transaction to take advantage of a applicant's or borrower's lack of understanding.
Yes.
Like you mentioned a moment ago, most people don't understand how compounding works or just some of the basic math that goes into calculating costs. And quite frankly, it is very easy and with some of these products to take advantage of an individual's lack of understanding. So that's something that is not only important, it's important to me, it's important to the company. It's actually woven into our code of conduct at Loanspark. So when we onboard a partnership, if that partnership has salespeople that is selling the Loanspark product or solutions, a part of that code of conduct is you will not take advantage of a small business owner's lack of understanding. And you will communicate clearly and educate them on the product, the process, the procedure, how it works, and what to expect.
It makes so much sense, Michael. And I've been involved in my time when I was still working for large banks in the UK. I was at the tail end twice involved in kind of the wider cleanup of mis-selling scandals. One time on the consumer side, one time on the SMB side. And long term, it is so expensive for all the organizations that were involved. There were so huge fines that they had to pay. There was so much money they had to pay back to these consumers and those small businesses. In the end, the ethical kind of stance always wins out, at least from what I've observed so far. And sometimes it can be kind of seemingly a good idea to do it short term just to get through, survive the quarter, show some good numbers. But in my experience, it's always coming back to bite people. And it's so much better to just kind of go the hard path and make sure you do things right from the very first day. And even though sometimes that means the road is more harder and more rocky and more uphill, long term, it's always better to do it.
I agree 100%. It was great to get a few moments here to spend some time with you and pick your brain a bit as to what's happening in the European market. And I'd love to do this again with you sometime in the future.
It was a great pleasure. I'll be back anytime you call me.